Tonight we begin with an economic collapse that global economists had warned about, investors had dismissed, and governments had quietly prepared for. A collapse that unfolded not over decades but in months, months that erased over $5 trillion in wealth, months that left entire cities standing empty, months that sent shockwaves through every major economy on Earth. What China's real estate sector did crossed a line that the global financial system had hoped would hold, and when that line broke, markets did not hesitate. They responded with panic, with sell-offs, and with a question nobody in Beijing wants to answer. Is this the beginning of the end for China's economic miracle? For over a decade now, there had been warnings, not from state media, not from official channels, just whispers, that China's property market was building something unprecedented. China's developers have been ambitious, yes, but they have been reckless in their ambition. Their moves have followed a certain pattern, a rhythm, almost a formula. Borrow money. Build apartments, sell them before they're finished. Use that money to borrow more. But what set off alarm bells in Washington, London, and Tokyo this year was that the formula stopped working. Analysts who monitor China's property sector know the indicators. The pre-sale numbers, the debt-to-asset ratios, the land auction prices, the sudden silence from executives. All of that went quiet. And whenever China's property giants go quiet, it means something is about to get very, very loud. In late 2021, international credit agencies detected what they described as systemic default risk, including missed bond payments that had not occurred in over 30 years of China's modern economy. These are the kinds of defaults that China's government only allows when they are signaling something very specific: a restructuring, a controlled demolition, or a complete loss of control. Observers didn't know which category this fell into, or whether it fell into all three at once. But what they did know was that Evergrande, the world's most indebted property developer, was changing from a symbol of China's rise into a symbol of its potential fall. And when a company with $300 billion in liabilities shifts from growth to survival without explanation, even by one quarterly report, the entire world pays attention, because Evergrande wasn't just a company, it was a system. A system that employed millions, housed tens of millions, and owed money to virtually every major bank in China. The warnings issued by economists and rating agencies weren't normal. They weren't routine, they weren't symbolic. They were urgent. Analyst after analyst described China's property crisis as unprecedented, systemic, and perhaps most importantly, contagious, meaning it could spread beyond borders. But a crisis only becomes a collapse if confidence breaks. And confidence broke. In fact, the speed of the unraveling was among the fastest we've seen in modern financial history. Here's what we know. Within weeks of Evergrande's first missed payment, Country Garden, an even larger developer, began showing the same symptoms. These weren't isolated incidents. These were dominoes, symptoms of a system that had been built on one dangerous assumption: that property prices in China would never fall. By 2023, reports confirmed that dozens of major developers had defaulted on bonds, including Sunac, Kaisa, and Shimao, companies that had recently been rated investment grade and were considered pillars of China's economy. The defaults came before Beijing could organize a bailout. They hit Evergrande, $300 billion in debt. They hit Country Garden, $200 billion in debt. They hit dozens of smaller developers that were preparing to launch thousands of new projects. In other words, the crisis targeted the engine of Chinese growth, the sector that accounted for nearly 30% of China's GDP. This is what made the warning so urgent. China's real estate crisis wasn't just symbolic, it was structural. It represented the kind of collapse that could drag down banks, wipe out household savings, and trigger social unrest if left unchecked. And Beijing, understanding that fully, responded with intervention. Not transparently, not consistently, but strategically. They didn't let Evergrande fully collapse. They didn't let the banking system seize. They controlled the narrative, censoring news, arresting whistleblowers, and injecting just enough liquidity to prevent immediate catastrophe. But they couldn't hide the ghost cities. And here's where the story becomes even more troubling. Economists now believe that China's property bubble was designed to sustain GDP growth long after the underlying economy had slowed. Beijing wanted to see whether they could grow their way out of debt. But instead, the opposite happened. The debt grew faster than the economy. Property prices peaked and then began a decline that was so rapid, so unexpected, that even Beijing noticed. You don't get the Chinese Communist Party's attention easily, but this crisis did. Analysts speaking with international media under anonymity described China's situation as a Minsky Moment, a sudden collapse of asset values after a long period of speculation fueled by debt. But Beijing has proven they remain both determined and secretive. Their interventions were not only aggressive, they were hidden so precisely that Western analysts are still piecing together exactly what happened. That secrecy matters because it shows one thing: Beijing is scared. It shows that China is not managing this crisis, they are surviving it. As reports continued coming in throughout 2023 and 2024, we learned more about the scale of China's property collapse. Evergrande was ordered into liquidation by a Hong Kong court, forcing creditors to write off hundreds of billions. Country Garden missed multiple bond payments that had been guaranteed just months earlier. Local governments across China, dependent on land sales for revenue, reportedly faced budget shortfalls exceeding $1 trillion. Over 50 million apartments sit empty across China, enough to house the entire population of Spain. This wasn't just a market correction. This wasn't just a bubble popping. This was an economic model failing. This was a social contract breaking. And that social contract, accept authoritarian rule in exchange for prosperity, is the one thing the Communist Party has struggled to maintain since the protests of 1989. For every reassurance Beijing has offered, reality has countered with something that undermines their credibility. Remember, China thought their property market was different. They thought state control meant stability. They thought endless urbanization meant endless demand. They thought they had solved the problem of boom and bust. But today, the exact opposite is happening. Prices are falling for the first time in a generation. Developers are collapsing faster than the state can save them. Consumers are refusing to buy apartments that may never be finished. And the world is watching a country that was supposed to overtake America stumble in ways that seemed impossible just 5 years ago. What makes this moment so dangerous and so unpredictable is that China's property collapse happened at a time when Xi Jinping is under immense pressure. Nationalists want aggressive moves on Taiwan. Economists want stimulus and reform. Local officials want bailouts for their bankrupt cities. Young people want jobs in an economy facing 20% plus youth unemployment. Xi Jinping is balancing these demands while managing the worst economic crisis of his rule. And when leaders in that position make sudden moves, they're not doing it from strength. They're doing it from pressure. They're doing it from vulnerability. This is why analysts are watching not just the economy, but Beijing's behavior. Because desperate governments do desperate things. Beijing's response, now analyzed by every major financial institution, was designed to signal that the Communist Party is not willing to accept a complete market collapse. Officials said plainly that the situation was controllable and that systemic risk would not be allowed. That is party language for, we're terrified, but we're not going to admit it. You don't usually hear that level of reassurance from Beijing unless something serious is at stake. And what's at stake is everything. The legitimacy of one-party rule. The dream of Chinese global dominance. The personal legacy of Xi Jinping himself. Meanwhile, Xi Jinping addressed the nation in a carefully controlled, heavily scripted speech. He said, "The Chinese economy is resilient and full of potential." He said, "We will not return to the old path of relying on real estate for growth." And he said, "The party will lead China through any challenge." These are not reassurances. These are admissions from a government that understands just how high the stakes have become. When you have to publicly deny relying on real estate, it's because everyone knows you did. Here's what makes the situation even more concerning. China's property crisis wasn't isolated. Along with the developer defaults, shadow banking exposure was revealed to be far larger than reported, potentially $3 trillion in hidden debt. Local government financing vehicles defaulted on loans for the first time in history. Consumer confidence collapsed to levels not seen since the beginning of the pandemic. All of this happened within the same 2-year period. When multiple pillars of an economy crack at once, it means something larger is underway. This isn't a correction, this is a reckoning. Economists are now considering several possibilities. One is that China is preparing for a prolonged stagnation, a lost decade, similar to Japan in the 1990s. Another is that Beijing is attempting to restructure the entire economy away from property and toward technology and manufacturing. A third possibility, the one worrying officials the most, is that Beijing is attempting to export its problems. using currency manipulation, trade pressure, and geopolitical aggression to distract from domestic failure. But today, the markets have taken action. Investors didn't wait for a rescue. They didn't wait for reforms. They didn't wait for clarity. They pulled their money out. Foreign direct investment into China went negative for the first time in recorded history in 2023. What we're watching now is a test of systems. China wants to see if they can manage decline without losing control. The West wants to see if China's weakness creates opportunity or chaos. Global markets want to prevent contagion. And ordinary Chinese citizens want to know if their life savings, often locked up in unfinished apartments, will ever come back. Tonight, we've heard from analysts who are now monitoring capital flows, bond yields, and social media sentiment inside China. They say protests are increasing, small, scattered, but growing. They say local governments are running out of money to pay workers and maintain services. And they say Beijing's decision to censor economic data is likely part of a broader strategy intended to hide the true scale of the collapse. But the world is not fooled. In fact, the world is preparing. Central banks are stress-testing exposure to China. Corporations are diversifying supply chains away from Chinese dependence. Governments are reassessing the assumption that China's rise was inevitable. The response today, swift, global, and irreversible, sent a message to Beijing that the world sees the cracks. And it sent a message to investors that China risk is real. As the months go on, we expect more details to emerge about what exactly Beijing hoped to achieve with their controlled demolition of the property sector. But what we do know is that the warning signs were visible for years. They showed a system built on debt. They showed an economy addicted to construction. And they showed a government willing to sacrifice truth for stability. What happens next will depend on what Beijing does in the next 12 months. If they embrace reform, this moment will be remembered as a painful but necessary correction. If they double down on control and secrecy, the world has already shown it is prepared to reduce exposure. They have shown they are ready to look elsewhere. And tonight, for the first time in 40 years, China appears to be on the defensive. The skyscrapers are quiet, too quiet. And when China's economy is quiet, it means they are calculating. It means they are choosing their next move carefully. Because tonight, Beijing learned something they have avoided for a generation. Growth does not last forever. Debt always comes due, and the world has options. This story is far from over. But tonight, one thing is clear. China's economic miracle is facing its greatest test. The outcome will reshape the global order. And the hidden truth is finally coming into the light. And we will be here, watching every detail as the next phase unfolds.